So, hi everybody. Steve Caton here from Alteza, and super excited to be having another one of these conversations with thought leaders. This is the third one that I've done, and someone was asking me recently, like, what's the why behind this? And so I'll share a little bit about that before we dive in. Alteza, which is an Italian word for altitude. We're all about helping business owners and entrepreneurs scale their business and grow. And we especially love it when we can help entrepreneurs kind of get out of that place where they're working in the business and get them to a place where they can work on the business. Well, part of that is, execution. And there's some sales execution that we bring to the table for that purpose. But part of it is also just knowledge, right? Learning and understanding some great best practices and key principles for growth. And so that's really the heart behind these videos is connecting with our partners, companies that we really respect and admire out there who are also providing great services to entrepreneurs and business leaders, and really just having conversations that can be helpful. So that's the why behind these videos, and obviously we hope that they are super helpful for you. So today, I'm super excited to be joined by Dave Ashworth, who is the leader of Quantify, which is a company that provides some really interesting services around, the financial side of our business. And I'm going to let Dave speak a little bit more about that. But then once we dive into the conversation, we're going to be talking about cash flow and ways to improve cash flow. And as we all know, cash flow is kind of our lifeblood for our businesses, right? And a lot of times we think in terms of revenue and expense, but there's much more to it. And so that's what we're going to dive into here with Dave. But before we do, Dave, say hello to everybody and tell us a little bit about you and about Quantify.
Yeah, well, thanks for having me, Steve. This is super exciting. I love the educational side of entrepreneurship, and I have learned a bunch from you already. And I love learning from other entrepreneurs, and then also being able to share some of my experiences and things that I feel like I've been gifted in to help the entrepreneurial community. So thanks for having me on here. I really appreciate it.
Yeah, you bet.
So I started Quantify. We're coming up on 10 years now, which is crazy that we've been doing it that long. It seems like we just got started. But we our focus is on that entrepreneurial small business community. We provide outsourced accounting services to those businesses. So some bookkeeping work, some controller type work, but our goal is to help businesses and business owners understand the financial side of their business. We always tell our clients every decision that you make has some sort of financial impact on your business, whether you know it or not. It's important for you to understand those things. And so that's really what our goal is, and our passion is to help business owners just make better, more wise decisions as they're navigating their business based on what the financials are saying, and having that information at their fingertips. So that's really what Quantify is all about.
Yeah, I love that, Dave. And I joke a lot about this, that I'm a sales guy, just purely a sales guy. So I'm all about creation of revenue. I'm not always all that great when it comes to the financial side of things. I've had to learn that. It's not an innate skill that I have, but I understand the value of it. And so that's why this conversation is so exciting to me, because I'm literally having this conversation with you so that I can learn about the things I need to be paying attention to as we grow our business. And I know this will be, a blessing to those who are getting ready to hear it as well. But yeah, I need this advice. So thank you so much. I appreciate it. So let's dive into the cash flow conversation. And I know you wrote a blog post a little while ago called 7 Ways to Improve Your Cash Flow. And so we'll kind of use that as the jumping off point or premise for the conversation. But, just create the backdrop for us in terms of, what you see in the cash flow conversation that maybe are the biggest misconceptions or things that business leaders just forget or don't think about in that conversation.
Yeah, so I think, and again, we'll dive into that list in a little bit, but I think that from what I've seen, and you kind of mentioned it already, is a lot of people get so focused on the revenue sales side of things and driving that. They get focused on cutting expenses, and those are all important things, right? If you don't have sales, if you're not increasing sales, if you're not cutting expenses, like you're not going to be around very long. But cash flow is a part of the conversation that often gets overlooked and is one of the most important things. And there's actually a lot of things that we'll talk about that, when we discuss them, they're very simple things that can be implemented in businesses, but they just get overlooked. And if you have negative cash flow, if you're putting out more than you're bringing in on a monthly basis, even if over an entire year, maybe it's positive cash flow or breaking even, you're going to be struggling in those months if you don't have a good plan for how to really get that cash flow back to a positive standpoint. And honestly, you may not even make it to the point of having positive cash flow if you can't get through those times. A really important conversation. If you can have positive cash flow in your business, you're going to have a really good chance of doing something well and making it a long time. And if you don't, you're probably going to struggle.
Yeah, absolutely. Well, let's dive in then, Dave. Talk about that in the 7 ways that we can be thinking about that will improve cash flow. Let's just jump in and start with the first thing.
Yeah. So the first one is just having an understanding of your bank balance versus your cash balance. You need to understand what that difference is. So an example would be, let's say you have $100 in your bank account. You go to write a check for $25, right? But that hasn't been cashed yet. So your bank is going to show 100, but in reality, the cash that you have is 75. And that's where a lot of people make a mistake, is because they log into their bank and they see what it's showing in their bank, and then they use that to make decisions. Well, that might not be how much cash you actually have if you have a bunch of outstanding checks or other things. And so the first thing is understand what your actual cash balance is before we can talk about anything else. And I see that missed. I see that missed a lot, unfortunately.
Yeah, that seems like a no-brainer, right? But I guess it's difficult for us to always have visibility into that. Do you have a quick tip in terms of how do you have visibility into what that cash balance is versus the bank balance?
Yeah, so I mean, I'm sure everyone's heard of a bank reconciliation. So that's gonna get you to that balance. So that's something that I would recommend doing as often as you can. Even if it's something that's just like a quick on, back of a piece of paper, every month. At a minimum, you should be doing that every month to get to that balance, where you kind of do your planning every month. But if you want to just go in quickly and just do a quick, even like I said, on a piece of paper, and just say, here's my bank balance, here's some things that are outstanding, and get it close. That'll just go a long way toward getting you to using the right number about where your cash actually is, and not just relying on what the bank says, basically.
Yeah, that's great. I know one of the things that's super helpful for me is our bookkeeper will just keeps a kind of a living spreadsheet, if you will, that shows income that we know about and expenses that we know about, right? And she has those by date, so I can kind of see throughout the month where the money is flowing in and out, and gives me at least an idea of where that cash balance is going to be at any point in time. It's super helpful.
Perfect. Yeah, and again, it doesn't have to be perfect. But getting close is definitely important, and it will go a long way. So that's the first one. The second one we'll dive into this one. There's a lot that kind of goes into this one, but it's your accounts receivable collections. And so there's a lot of things that are involved in the accounts receivable process that can really help or hurt your cash flow. And the first thing is, and again, this is missed a lot, is sending out a bill is just the first step in accounts receivable. Once you send it out, then you need to start following up on it. You need to make sure it's getting collected. There's a lot of other things that need to be done than just like send it out and let it go. So I think I have 7 ways, and I'll go through them quickly, and then we can talk about them. But of how to speed up your accounts receivable. So the first is and these are very basic things, but they're important to help this, and they add up. So invoice quickly. You finish a job, don't wait a week to send an invoice out. You're obviously not going to get paid in that week. An easy thing to do is, as soon as you finish a job, or even better, if you can bill up front, get that invoice out the door. Get it out as quickly as possible. The second thing is, if they're hard to understand, that's going to slow people down from paying it. If I pick up an invoice and say, okay, where do I send this? How do I pay it? What do I do? Got something else to do. Let me put it aside. But if I can pick it up and say, okay, there's my amount. Here's where I pay. Okay, boom, let me hop online and pay. Good to go. You're going to get paid a lot quicker. So that's the second thing. Simplifying the payment process, that goes hand in hand with that. If it takes, you know, if you only accept checks, right? I got to pick up a check. I got to fill it out. I got to put it in an envelope. I got to put an address on it. I got to take it to the mailbox, right? Yeah, it seems like a really simple thing, but that's like a lot of steps for someone that's running around every day. So simplifying that process. So maybe I'll stop at those three and then keep going. But those are three right off the bat to speed up your accounts receivable.
Yeah, it makes me wonder, Dave. So if I'm running a business where our customers are paying us on a monthly basis, for
Mm-hmm.
services
Yep.
rendered, isn't it like the best thing to do is just set those payments up automatically so that they're basically kind of hitting either a bank draft or a credit card every month?
Absolutely. Yeah. If you can do that, again, every business is different. Some businesses can't do that. If you're a service provider, especially providing monthly services, our business, we set up ours exactly like you said, automatic. And we bill on the first of the month for the services to be provided in that month. So we're a month ahead. If you can do that, that is absolutely the way to do it. Again, that doesn't work for every business, right? If you're selling a product, you can't bill it up
Yes.
front. Like you got to
Yeah.
obviously sell the product, but
Yeah. Obviously.
as
Yeah.
much as you can, try to be doing those things. It's going to make a big difference.
Yeah. That's great. Okay.
Um,
Cool. And I
yeah,
think you were going to talk about accounts payable next, right? Since you
yeah,
just touched
yeah.
on
So
receivable.
let's dive into accounts payable. So first of all, it's important to know who you owe, when you owe them money, and how much at all times. You should always know that. And it's not, again, this is like a really simple principle. I have a couple things listed here, but I know in my head that I owe these people. It's like that's just not good enough. You need a list of those three things, and it should be all inclusive, and that should be so you know exactly how much money is going to have to go out the door and when. Because if you don't know that, how can you project where your cash flow is going to be?
Yeah.
So that's like the starting point is understanding exactly who you owe, when you owe, and how much.
Yeah.
And then once you kind of have that, now you can start looking at your processes. How do you pay invoices? When do you pay them? What operating procedures do you have in place for? Do you pay it? The day that it's due. Do you pay it early? Do you wait a little bit? Start to look at those things. And then as you're looking at that, make sure that you're looking at like late payment charges. These are simple things that can be cleaned up that shouldn't be incurred in a business. Late payment charges, double payments happen sometimes, missed payments. There's all different things that you can be looking at that is going to help your cash flow if you just start to get a better picture of what is going on. And to help with that, there's some automated processes and different softwares that you can put in place. An example would be like a bill.com.
Yeah.
That's something that we use for a lot of our clients, where all the bills are centralized in one location. It has those three things, like I said, who it's to, when it's due, and how much. And then you can go in and approve those bills, and then they send them out for you. That helps to automate the process a little bit, so you can have a clear picture of what is going on, when it's going out, and so that can really help with your cash flow from an accounts payable standpoint.
Yeah. Yeah. That's great. It's really helpful.
Yeah. So that's, so we've covered AR, we've covered AP. The next piece is now starting to do some cash flow projections, projecting out like what does your cash flow look like? Because the reality is you may be better off or worse than you think. And I'll give a quick example. So let's say that I have a bunch of money coming in, but then in the next month, my big expense for, let's say, my insurance for the year is coming up that I have to pay in full. Well, if I just looked at this month, I'd say, oh man, I have all this money. I can go out and increase my marketing spend and spend here and spend here. And then I get to the next month where maybe there's not much money coming in and I have this huge expense and now I'm in trouble,
Mm-hmm.
because I spent all this money that I thought I had, to spend, but I didn't because I just didn't look out a couple months and see that I owed something big. And the reverse can be the same true. I might not be doing well this month, but I know in the next 2 months I'm going to collect, two of my biggest clients' bills coming in, and I'm actually in pretty good shape. And so projecting out, looking ahead a little bit, is really important because it's always going to look a little different than it does exactly today. And so you want to kind of have that view of things as you're kind of looking into the future.
Yeah. That's, yeah, I think we can all think about times we've been burned by that
Yep.
situation for sure. I'm curious now, in your business model at
Mhm.
Quantify,
Mhm.
what function is actually doing that piece of it there? Is that the
Mhm.
controller piece? Is that
Mhm.
the bookkeeping piece? Who, yeah, I'm always like wrestling with what's the difference between
Sure.
outsourced CFO, controller,
Mhm.
bookkeeper. So maybe give us a little clarity on
Mhm.
whose role it is to look at something like that.
Yep. So that would be probably more of a controller level
Okay.
role, where they're kind of putting that process in place. And then if you're looking to more of the strategy behind the cash flow, then that would kind of push into more of the CFO bucket.
Okay.
Really, the controller is something that could handle that type of, creating that forecast and looking at it with you. And typically we recommend like just a 12-week lookout, 12 weeks. That gives a pretty good picture into what is going on and keeps things in line. You can obviously go further if you want. It could just be an Excel document where you're just starting with your beginning cash balance, what's coming in, what's going out, ending balance. You do that over 12 weeks and then look every week, what is your balance going to be? And then if you start to see it's negative and trending more negative every week, then you know that you got to adjust something right now, or in 12 weeks, you're going to be, way in the hole. And so you can then start to make changes today to make sure that you're keeping your balance where you want it to be in 12 weeks, basically.
Yeah, yeah, that's super. One of the conversations you and I had that was helpful for me is understanding the difference between the bookkeeper and the controller. Whereas
Yep.
and I'm
Yep.
simplifying this for sure, but
Yep.
for me, it was really easy to grasp the idea of the bookkeeper is really providing an accounting of what's already happened,
Yep.
but the controller is actually, like you just said, looking out a little bit ahead and
Right.
anticipating what's coming, not just telling you, here's what here's what came in, here's what we
That's
spent.
right.
So
That's
yeah,
right. For sure.
yeah,
For sure.
yeah.
Um,
Okay, so what's next?
yeah. So the next one is, again, is very simple, but it's being aware of very small cash flow issues. And that could be about anything that we talked about so far. Maybe your accounts receivable comes in a little slow, or you have a couple late payments, some bank fees. It's a bunch of small little things, but those can add up into, a major cash flow issue. So this isn't necessarily a very specific accounting principle, but it's more just, even if you have little things going on, clean those up. Even if it seems very minimal, as you do more of those, that's going to add up into be, could change you from a negative cash flow to a positive cash flow. So don't overlook the little things. Again, very simple principle, but you do see that come up where some of these little issues get overlooked, and then it turns into a big issue as it relates to cash flow.
Yeah, yeah, those little misses can become big over time, right?
For sure, for
Yeah,
sure.
yeah.
So again, that's a simple one. So the next one is projecting your revenue too high. And I want to preface this one by saying that, you should set goals, you should set lofty goals. We do that here. But when you're dealing with cash flow, you want to make sure that you're projecting your revenue properly, because if you project it too high, then you're going to look and think, okay, I'm in really good shape. But then when it actually comes in lower, because you're just, you know, as entrepreneurs, like, we just have big goals, and we're like, oh yeah, I'm going to make $1 million like every month, right?
Of
Like
course.
that's what
Yeah,
that's how we approach things.
yeah,
But when you're looking at cash flow, you have to be a little bit more realistic, because if you think you have all this cash coming in and then it comes in lower than it actually does, actually what you projected, you're going to run into trouble from a cash flow standpoint. So again, I'm prefacing this one by saying set goals, set high goals, go after those. When you're looking at cash flow, just make sure you're realistic, and even be conservative on it a little bit, because that's going to keep you in line. That's going to allow you to plan better. If it comes in higher, then that's great. Readjust and go from there. But don't set it too high. You will run into issues from a cash flow standpoint.
okay, yep, that totally makes sense.
Yep. And then the last one is just having an understanding, and this kind of goes just with the whole conversation, is understanding your revenue cycle.
Hmm.
Every business has some sort of cycle. Now, some are very just consistent throughout the year. The revenue is consistent month after month. Some are very cyclical, where they have a season where it's like, we don't do taxes anymore, but when we did, we January through April was our big revenue push, and then the rest of the year kind of flattened out from there. Um, that revenue cycle, because during those months we felt like we were great, we had all this money, we could do whatever we want. But if we didn't project out and plan for July and August when not much was coming in, then we were going to be in a lot of trouble. So understanding that cycle as it relates to cash flow is very important in any business.
Okay, so quick question there. I know, so when I was served on a board of a nonprofit, years ago, and that nonprofit was experiencing the ebbs and flows you're talking about, and in the nonprofit world, typically there's a whole bunch of money that comes in the fourth quarter, right? And that ends up being kind of the year, and makes or breaks the year. But when we were looking at budgets, oftentimes we'd be looking at budgets that were based on that total number, that total number of, giving that was expected over the course of the year, more kind of annualized, in a flat line kind of concept, right? As opposed to reflecting the ebbs and flows. So we would, as a board, sometimes be a little bit in panic mode, looking at how far behind projections we were. And then they would always say, "Oh, we'll catch up at the end of the year." So talk to me about how do you, like, that doesn't seem very helpful to me. So what do you do to make it a little bit more realistic with what's happening in the moment?
Yeah, I think there's a balance there. I think for a lot of, specifically like the nonprofit, like you mentioned, I think it's okay to kind of spread that revenue out a little bit. Especially if there's a long history of that happening, right?
Okay.
Like if every year it's like, okay, we're going to bring in, 50,000 a month, and then the last 3 months we're going to bring in 500,000 a month, and that's been happening for 15 years. Then yeah, I think projecting it out and knowing that's going to come in, I think where people get in trouble is they don't have the history with that. They think it's going to happen because it happened maybe one year, or it never happened. They just think it's going to happen. Obviously, in those situations, you need to spend money throughout the year, right? You have payroll and things that needs to keep an organization going throughout the year, or else they're not gonna survive, knowing that the money will come in. So that's just a tough balance. I tend to be a little bit more conservative as much as I can, unless, like I said, that history is there that shows like this is going to come in. We've been doing this for a long time. It's going to happen. That's where then I might be a little bit more aggressive throughout the year. But there's not a great solution to that, because that it is challenging to do that. But you do have to still run the organization, run the business as if it's coming in, if you're pretty confident that that's what's going to happen. And then if it doesn't, you're going to have to adjust the next year and kind of readjust, look at what happened, and make changes to fix that. And sometimes if it doesn't, if you come in way under of what you're projecting, there's going to be some hardships and some problems with that. So not a great. There's not like, with those type of businesses and organizations, there's just not a great answer to something like that, because you just don't know what's going to happen. Like, unless just that history that's proven it over time.
Yeah, I think the history piece is really insightful, because if you do have that pattern, repetitively repeated pattern, for a number of years, that okay, we've either got to set aside some of that revenue that comes in during those peaks, so that we can fund the valleys, right? Or that's where we might tap into lines of credit or those kinds of things. We know where that's going to happen. We can plan for that. When we have the predictability and the visibility, allows us to do some things that could be really smart in terms of keeping our business on track. So I think that's really, really wise.
And that's a great point that you brought up, because that can fund the valleys, and then it's coming in. So you don't necessarily need a loan for years. You just need to fund that. The money comes in, you pay your line down, and you move on. And so one recommendation that I would make with a line of credit, because I encourage every business and organization to have a line of credit, even if you don't need it, is to get it when you don't need it, because once you need it, you're not going to probably be able to get it. So that is something from a cash flow standpoint that I can't recommend enough to every business out there that's listening. Go and get a line of credit. We have a line of credit in our business. I don't think that we've ever used it, but we have it. If we ever need it, it's sitting there. Doesn't cost us anything, and that's something from a cash flow standpoint that can really that can really save you. But even more so in businesses that have those ebbs and flows, that could be a big deal.
Yeah, yeah, that's great. Okay, awesome. So is that the list?
That's the list. That's the list. Yeah, I can. Let me review it really quick. I'll just run through it. So
Yeah, that'd be great.
yeah, first is just understanding your bank balance versus your cash balance. The second is speeding up your accounts receivable collections. Third is understanding and tracking your accounts payable. Fourth is projecting cash flow. Five is identifying and fixing small cash flow issues. Six is stop projecting your revenue too high when you're dealing with cash flow. And then the seventh is understanding your revenue cycle.
Yeah, that's awesome. That's a great list. And I know, Dave, that you guys are all about helping your clients do all of those things all the time. So for anybody that's watching this who's going, I need some help with this, how do they get in touch with you?
Yeah. So I mean, I spend a lot of time on LinkedIn, so you can look up my LinkedIn profile. My email is dashworth@thequantifygroup.com, and that's also our website. So any of those ways is fine, or just reach out to Steve, and he'll get you in touch with me. So
That's right. Yeah, absolutely. Well, Dave, thanks for having this conversation. I think it's really relevant as we are kind of closing the books on the current calendar year and thinking ahead into 2022. What are some of the disciplines that we can implement, going forward that can help us have healthier and thriving businesses? So this is super helpful. I know for me, I learned a lot, and I'm sure others did too. So thanks for taking the time. Really appreciate it. Thanks for what you do for to help entrepreneurs grow their business in a really healthy way. This stuff is so important, and glad you're out there doing it.
yeah, thanks for having me, Steve. This has been awesome.